So if you're a Dollarama investor, March 24th was probably a pretty rough day. The stock just fell off a cliff, and everybody was left asking the same question. What on earth just happened? Well, today, we're going to do a proper value investors audit and figure out what's really going on under the hood.
When Dollarama dropped its latest earnings report, the market didn't just react, it kind of panicked. The stock plunged 8% in a single day. I mean, that's a sharp, sudden drop that left a lot of people scratching their heads, wondering what they missed.
Now, the easy story, the one you're hearing everywhere, is that it's all about Australia. Their big expansion down under is losing money. But that might just be a distraction. For savvy investors, the real fear is that something might be wrong with the core business itself, the Canadian machine. So, let's investigate.
Here's how we're going to break this all down. First, we'll look at the company's Canadian fortress. Then we'll examine their big gamble in Australia. After that, we're going to uncover some hidden costs, try to figure out the real price of the stock, and finally, I'll tell you the one thing you absolutely have to watch going forward.
All right, first up, the fortress. Before we can understand why investors are so nervous, we really need to get why Dollarama's core Canadian business is so darn powerful. You can think of it as their economic moat.
See, Dollarama's strength isn't just about selling things for a couple bucks. It's a brilliantly designed business model. They practically have a physical monopoly on the best, low-rent retail spots in local neighborhoods. You combine that with a super efficient supply chain and the flexibility to price things up to $5. And yeah, you've built a real fortress.
And just look at this chart. It tells you everything you need to know about what that fortress can do. Dollarama's gross margin is a staggering 45%. As you can see, that absolutely dwarfs the average retailer, who's lucky to get 25%. This isn't just a store. It is a high-margin, cash-generating machine.
But, and this is the part that really matters, that last earnings report showed what could be the very first crack in this supposedly unbreakable fortress.
The problem is a number called same-store sales growth. It's really just a fancy way of asking, are existing stores selling more stuff than they did last year? Well, that number came in at only 1.5%. That's a huge warning sign. It suggests one of two things. Either Canada is running out of new customers, or Dollarama's price advantage is starting to fade as its prices go up. So if the fortress at home is showing some wear and tear, what does the company do? Well, that brings us right to Pillar 2, the gamble. Management is taking all that cash from Canada and making a huge bet on the other side of the planet, Australia.
The strategy itself is pretty straightforward. You take the predictable profits from your mature Canadian business and you pour them into a brand new, long-term growth project. The only catch? That Australian venture is losing money right now while they try to get it up and running.
This is a classic move for a big, successful company. Think about it. When you can't grow as fast at home anymore, you've got to find new places to put your money to work. This almost always means your return on invested capital, which is basically how much profit you squeeze out of every dollar you invest, is going to drop for a while. It's perfectly normal, but it's a sign that a new, tougher chapter is beginning.
Okay, on to Pillar 3, the hidden costs. This is where we look under the surface of the financial statements and see the new pressures that are starting to build up on the business.
And this isn't just about the cost of the Australian gamble. The day-to-day job of just running the Canadian fortress is getting more expensive. That smooth, high-profit machine is starting to make some noise, and there are two big reasons why.
So as you can see here, two key costs are climbing. First, look at interest expense. Higher interest rates mean it costs more to borrow money, and that just eats directly into your profits. Second is something called maintenance CapEx. Now, this is money spent just to fix up old stores, not to build new ones. Both of these act like a drag on real growth.
So, what does all this mean for the stock price? Well, that brings us to Pillar 4, the real price. Let's try to figure out what the market was really punishing with that big 8% drop.
The surface-level fear is all about Australia's losses. But the deeper concern, the one that truly spooks value investors, is the idea that the quality of the core Canadian business is starting to wear down. So the market isn't just punishing a risky bet, it's starting to question the foundation of the whole company.
And this really gets to the heart of what value investing is. It's not about finding something that's just dirt cheap. It's about finding a mismatch between the price you pay and the quality of the business you're getting. So the question for Dollarama isn't, is it a good company anymore? The question is, does the current stock price accurately reflect this new reality of slower, maybe lower quality growth?
And this all leads us to our final and most important point. If you take away just one thing from this entire analysis, this is it.
Right now, everyone is totally obsessed with this question. Will Australia succeed? But frankly, that's a distraction. It's an experiment. Focusing on its day-to-day profits right now is like watching the wrong ball.
This is it. This is the whole game. The health of the Canadian fortress is what determines the real value of this company. Is this slowdown just a little blip on the radar, or is the high-return model we all know and love actually being downgraded for good?
So here's what it all comes down to. The market will forgive a company for a risky experiment like Australia. That's okay. What it will never forgive is a sign that the main cash machine, the core business, is starting to break down. So if you want to understand Dollarama's future, stop worrying about Australia. Instead, keep your eyes glued to the profit margins in Canada. That one number will tell you everything you need to know about the health of the fortress.
And just a quick reminder, this analysis is purely for informational and educational purposes. It is not financial advice. Please always do your own research and consult with a qualified professional before making any investment decisions.